Understanding core risks in banking. Asset-Liability Management. In the world of banking, Asset-Liability Management, ALM, is a critical function that addresses three primary risks faced by banks: capital risk, liquidity risk, and interest rate risk. For banking professionals, understanding these risks and implementing effective measures to manage them is crucial. Capital risk. Capital risk is essential in protecting banks from insolvency caused by losses. Traditionally, impaired loans were the main source of loss, but today, banks face diverse sources such as trading losses, goodwill impairment, and regulatory fines. Safeguarding a bank from insolvency ensures the protection of depositors' funds, a key responsibility. To finance future growth, core capital is primarily provided by equity investors and retained earnings after paying dividends. This capital, referred to as Core Tier 1 capital, must adhere to regulatory requirements for maintaining a minimum amount of capital relative to risk assets. The capital adequacy ratio, which measures Tier 1 and Tier 2 capital against all risk-weighted assets, is a critical measure monitored by regulators. Liquidity risk. Liquidity risk arises primarily from the maturity transformation function performed by banks. If confidence in a bank is shaken, resulting in a series of loan losses, it can lead to a liquidity crisis. This loss of liquidity often triggers bank collapses. To mitigate potential liquidity issues, banks maintain sufficient liquid assets on their balance sheets. Regulatory bodies typically impose minimum requirements for these assets. Banks also rely on maturing assets and wholesale market access to enhance liquidity. Metrics such as the customer loans to deposits ratio and the number of days a bank could survive without rolling over positions at maturity are used to assess liquidity. Interest rate risk. Interest rate risk stems from fluctuations in the yield curve. This risk primarily affects a bank's earnings, specifically the net interest margin, which greatly contributes to profitability. Structural risk, driven by the difference between rate-sensitive assets and liabilities across various repricing periods, constitutes the main interest rate risk for banks. Additionally, market risk, arising from the fluctuation in the value of fixed-rate securities, is another significant source of interest rate risk. ALM also encompasses other critical risks, such as concentration risk, settlement risk, securitization risk, and pension risk. Basel II Pillar 2 requires banks to identify, analyze, and stress test these risks, ensuring adequate capital support, as per regulatory satisfaction. Lastly, a bank's credit rating affects various key areas, including the cost of wholesale funds and the types and amounts of business that wholesale and corporate counterparties are willing to transact with the bank. Maintaining a strong credit rating is essential for bank success and credibility. Want to learn more? Claire Trithel on LinkedIn